Good morning. This is Tom Alexander. It is Sunday, January 15th. It is about 10:18 a.m. Eastern Time in beautiful Charleston, South Carolina. This is the video report that is an addendum to the written report that I send out every week. That report is free. If you are not receiving it, please send me an email to tom@alexandertrading.com and I'll happily put you on the list and you will get all my free stuff. Another thing that would be extremely helpful, if you find value in this video, please like it, please subscribe to the channel, and by all means make comments. All of these things help generate activity for the magical search engines. So that would be a big help to me if you will subscribe, like, and make comments. If you have questions, I'm happy to answer your questions. Okay. First part of the year, first couple of weeks is now behind us. And at this rate of change, the Russell will be up 100% by the end of the year. If you think that's going to happen, I don't really think that's going to happen. I do think, and I mentioned this maybe 2 weeks ago or longer, the Dow has held up extraordinarily well. It's possible now that we're in a new bull trend. That's just the reality of price action. I'm not a macro guy. I don't try to figure out the macro equation. I follow price action through the lens of auction market principles. And price action right now has been very, very positive. We broke out of balance areas recently. I discussed that in videos over the past 2 weeks and the reports the last 2 weeks. You can go back and look at those. Let's look at the charts for a minute here. Okay, here are the four primary U.S. trading indices: the cash markets, the S&P, the Dow, the NDX, and the Russell. And we'll look at each one individually, but I want you to look at them as a whole. I think this is something that is missed by many traders. Everybody, the vast majority of short-term traders want to trade the S&P futures or the SPY, and that's all they fixate on. Well, that's fine, but one of the primary tools you can use is to look at the other four and understand the relationship among the four, because they're extraordinarily highly correlated contracts, and they tend to behave in lockstep, especially when you're in a strong bull leg or a strong bear leg. And the bull bear thing is a matter of the time frame you're using. Are we in a bear market? Are we in a bull market? I don't really care. I'm just going to follow price action. I don't want to get run over regardless of what you call where we are. I follow price action. Price action is up. Now we're coming out of these balance areas in all four of the indices. But now the interesting thing, if you look at these balance areas, they formed at different levels, very different levels. All four of them did, actually. And the NDX came down and tested this critical level and could not break through. I think that's a pretty significant event. I also think it's significant that the Dow held so extraordinarily well. It never took out that November 9th low, which was the day before the big ramp higher. Whereas the Russell traded down into this volume, it took out that November 9th low. And these are all things that I've been talking about in this report for many weeks. Something I do, I put links to previous reports in each written report, the previous 4 weeks. So, I mean, you can go back as far as you care to go back in these reports and see what I was saying at the time and how things have turned out. So where are we now? Well, if you look at all four of the indices, we're approaching, to varying degrees, extremely critical upper key reference area. So this is where we're going to stop for a minute and we're going to look at each one. I'm going to start with the S&P, the SPX. Now, there is a widely publicized trend line that connects each rally attempt following the decline that began back a year ago in January. And every time we've touched that line, it's been strongly rejected. We had a little bit of a false breakout here and rejected. Also, another current fixation is the 200-day moving average. Now, the 200-day moving average is important to a lot of people, institutions included, big money included. You can have rote buying, just automated algorithmic buying, because we crossed the 200-day moving average. And the S&P, the SPX, has now closed above its 200-day simple moving average. It's on the cusp of closing above this trend line. So that could get the animal spirits working to the upside again, and maybe we spike through this level. This level is really important. Now, let's look at the Dow. The Dow is not far from its upper key reference area. That is the same level, the same dates as that of the SPX. And above here, you really have less and less until you get to new all-time highs. We are, how far are we from all-time highs? As of the close, we're less than 8% from all-time highs in the Dow. That's, we could do that easily in a month. So that's interesting. Now let's look at the NDX. The NDX is lagging. The NDX is still comfortably below its 200-day moving average. It is also below its trend line. The 200-day moving average comes in this key reference area that includes the same dates as the key reference area of the SPX, etc. Also, you can see how deeply we retraced, and they could not get it below this level. This level now going forward in any time frame you choose is going to be critical, and it will at some point be tested. I don't know if it's next week, next year, or the year after. This level now is an important intermediate to long-term level in the NDX. No equivocation about it. Okay, let's look at the Russell. The Russell has blasted out of this balance area into the its upper key reference area, and in doing so has blown through its 200-day moving average. So what are we seeing here in this mix? Well, we're seeing leadership in the Russell, we're seeing leadership in the Dow, and we're seeing the NDX and the SPX lag. Obviously, the SPX is being dragged down by its technology component, and the Russell and the Dow are benefiting from a lack of exposure to that sector that has been so extraordinarily weak. But again, I say this all the time, in long-term, intermediate-term trends, you have everything moving in lockstep. Now, short-term, yes, we have everything moving in lockstep. But when you look at the key reference areas here, there's very disparate activity between and among the key reference areas that is sort of a lingering issue if you think we are now in a new bull trend, and here we are in the S&P off to 5,000 and above. So let's look at shorter term stuff now. Let's go over and take a look at the technical picture, which is really interesting in my mind. Okay, so I use very simple things in my trading. I use price action. The only indicators I use are derived from NYSE data. It's specifically advanced decline data. I keep 10-day moving averages of advancing issues, 5-day moving average of advancing issues, just the advancing issues. And then I keep breadth, which is the net change between the advancing and declining issues on a closing basis. Also, if you're on a 30-minute basis, I'll show that in just a minute. Okay, so we closed on Thursday. The 10-day moving average is the highest it's been in years, and the 5-day is as well. Now, does this mean we're overbought? Well, it's extreme. I do not like the terms overbought and oversold, because extreme is a more accurate term, and it implies a relative reading, a relative view. So relative to what we've seen for a couple of years, this is extreme. Now, that doesn't mean the market is about to crash here. It doesn't even mean it's about to have a meaningful decline of, say, 1 or 2%. It's a little bit of a heads up that short term we might be getting extended. We've had 6 consecutive days of positive closing breadth. That is the most we've seen in well over a year. So you can make the case, well, gee, this is a lot of upside momentum. It's going to take some time to wear that momentum off. And I'm sort of in that camp. Now, that does not mean that we won't get some retracement. As a matter of fact, retracement, I would sort of be leaning towards retracement that begins by no later than late Tuesday or early Wednesday. And that's just a total guess. There's nothing rigorous derived. That's just my hunch from 38 years of staring at this stuff, staring at a screen. Now, another thing I'll point out, if you say, okay, well, this is extreme. Well, this was extreme too. And this was a little bit, this is more extreme than this, but close enough. The point is, from this level, the S&P, the SPX rallied almost 5.7%. Well, if we were to rally 5.7% from here before we get any sort of meaningful decline, then you're looking up here around above 4,200 before, into the 4220s before we have any sort of 1, 2, 3% retracement. Another thing I'll bring your attention to, though, once we reach this level, you can see there was a period of about 8, 9, 10 trading days in here where we were choppy. The market formed balance. Time regulates price. That's one of Peter Stedelmeyer's precepts, and that is one that has held the test of time. Time regulates price. That's an auction market concept. So I would expect some regulation to kick in here and for the immediate ramp higher to begin to slow down and to see more overlap on a day-to-day basis. I think it's very important that this structure hold, this balance area hold. If we were to get a deep retracement down to around, into the high 38, 80s, that would not be a big shock at some point. It also, frankly, wouldn't be a shock to me if we don't grind towards 4,100 before we get even more two-sided and we get deeper retracements. I don't think, and this is a guess based on experience, I don't think we're going to go from here and just blow through 4,100 before the market spends some time and does some back and fill and some churn and we form balance areas in here. So this is something we'll be watching very closely over the week. Now, I'll come back to this page in a minute, but I want to show you 30-minute breadth. We're already beginning to form, and I would encourage you to go back and listen to last week's video about the position of breadth last week. We got up into this. Now, this is a 30-minute chart, by the way. This is day session. This is the futures contract, but day session hours. And so last week we reached an upper extreme from where for weeks or months, every time we reach this extreme, you'd have almost an immediate top. And I put in the report last week, it has to be different this time if that initiative break out of that balance area was going to act indeed initiatively, and indeed it has so far. So what we're seeing now is the normal relationship between price and breadth in a bull leg. Now, we have this divergence as we head into Globex trading. I think, tomorrow's a holiday. I think Globex opens tonight. Who knows what's going to happen? But as far as the cash market is concerned, and that's what this will update, this will update in the cash market. I don't know if this is portending some sort of retracement into the previous day or two's range, or if we're just going to blip up again, reach this level, and then set another minor divergence. You can already see these divergences do tend to precede at least minor retracements. We've had 1, 2 already. Will this be a third? Maybe. You can have this can go on for weeks. in a strong bull trend. And this is what I constantly warn my clients about trying to rote trade price and breadth. It's more nuanced than that. It has to be put into a context. We are in a strong trend. As long as we are making higher highs and higher lows, the trend is intact. And you can take that rule and apply it on a 1 minute chart, a 5 minute chart, a 30-minute chart, an hourly chart, a daily chart, whatever time frame you want to choose. And there's nothing that can be that is more accurate in helping you to determine a trend or potential change in trend than that little simple test. Is the market making higher highs and higher lows? The indices are making higher highs and higher lows. Now, we are approaching upper key reference areas, and I would expect to see some sort of more two-sided trade, maybe a little bit deeper retracement somewhere between where we are and those key reference areas. And again, we are in various stages of reaching those key reference areas. We're right at it in the Russell. We're well below it in the NDX. So that all comes into play. All right, let's go back over to the technical page for just a minute. And something else that we've been watching and talking about is VIX. VIX closed the lowest level that it's closed since 2020, somewhere back over in here, over a year. And VIX in this latest decline acted, and of course this is hindsight, it acted really, really well. It was never able to generate anything. You had this one tiny little spike up, but since then, it's been pretty muted in this decline, and now has absolutely cratered the last couple of trading days. So a low VIX implies higher prices, and this goes on the bullish side of the ledger. Okay, guys, we will have an interesting week in front of us. I hope you have found value in this. And again, it would help me tremendously if you would subscribe to the channel, like the video, make comments. Please, by all means, send this link to your friends, put it in your chat rooms, etc. I'll be in touch. Have a great week.